Okay, we have call recording is on, and I'm going to confirm that, and it looks like it is. So we're going to start out today is the price action Q&A number 2. So today we're going to discuss all of the new issues that I've heard, and while I received a ton of emails that were on the same subjects, if I miss something, I'll try to backtrack at the end if it can be covered, and if it can't, it'll make a future third Q&A call. In this experience, I do want to tell you that this is my first time, between November and now is my first time ever fully teaching this to anybody. I've taught somebody a setup. I've said to a friend, look, you're getting burned. Let me show you, this one thing and keep your mouth shut and just do right shoulder failures. Or I've said to a friend, look for this pattern in M bottom or whatever it is. Or I showed them how to buy the bottom of a bull flag, or I showed them how to, do one or two simple things. And some of those people succeeded, and most of those people that were friends over the years that I gave advice to still didn't make money. And the reason why is this is a game of psychology, and this is a game of following the parts that you don't want to hear, which is tracking and money and the thought about the formula, the math, the simple math and how this works, and losing professionally. And so we'll get into that stuff, but as this learning experience has grown for me, I'm learning how to teach it or regurgitate it, in fact, in ways that people are finding use with it. I will tell you that I have a couple people in my feed now, and I haven't allowed anybody into my feed, but I let maybe 3 people in recently. I've really kind of said, no, I'm really trying to hold off until people were ready. But what I have is a few people who are having the most success are the least experienced. And that's because they had so little wrong with them to start with. And they had so little opinion, or they have been they lack so many other experience to fight it that they find success. Or I have some that have the exact opposite experience, where they have learned so much, read 25 books, and now, for some reason, all of it gels together, and they now start having a working system. But we'll discuss why and where I'm going with this, and we'll kind of discuss this. For some of you, you have already found that path. For some of you, over time, you will find that thing where I pinprick you with some piece of information, and suddenly the light bulb will go on, the chills will run down your arms, and you'll be ready to get really serious about doing this. So the first thing I had to cover, which we do every time, is this is covered by the non-disclosure agreement you sign. This is part of that data. And so I want to make sure you understand everything we discuss here cannot be reproduced or sent out on the internet or sold on eBay or any of that stuff. It's private, and you are responsible. You sign an agreement. Second thing is Slack feed. Everyone has asked how they get on the feed, and the answer is I have been holding off because it would not be fair to the individuals who are experienced from the first class to have to deal with a lot of intro questions from somebody who hasn't done the homework and learned the process. This week, as in tomorrow or the next day, I will send out an email with a link to sign up for the Slack feed. I will do that probably this week, and next week I'll allow it. And then after that, I'm going to close it up for a while. Let those people, I will ask those new people to not start posting, but to read, see what we've been doing till they start to get a gist for what we're moving, what we're doing in that feed. And admittedly, I'm changing how we use that feed. I'm brand new to this Slack thing, just like everybody else who has been using it for about a month, and if it's even a month. And I'm learning new things, how to create separate channels for just questions for me, because I can't read everything everyone posts. There's, 1,000 posts in there. And what I want to post, meaning do I want to post and show myself real-time reading the market? And the answer is, that's fun for a little while, but once you guys know what I look for, you don't need me for that. The feed really is about me finding setups and spending time to tell you what I'm buying or what I'm seeing so that it will create trades for you. And that's what I'm getting from some of the people on the feed already is I'm getting people saying a name and a stock symbol that have something special, and I'm looking at it and taking a position. Currently not full position because I don't like this market that much. I do know we're in a distribution area where price is poking higher, and each time there are professional dollars that are being run off the market, so they're selling into that strength. So knowing that, I'm not even taking a lot of full positions right now. I think my only full real large position is DV, DeVry Institute, or whatever that is, which I bought lower off that back test. And even that is, I mean, it has a lot of good things about it, but I'm really not aggressive. So that covers Slack. You will get an invitation. It'll be an email. You'll have a chance to join. Admittedly, I'm a little afraid, so please don't jump in asking questions like that. I need you to study the material so that you know what you're doing before you jump in. And then once you're in the feed, you'll start to see how to use it. And I will be putting out a video, which I'm stalling on because I'm learning Slack too. I will put out a video on how to use Slack. Okay. So how long to sit on a setup? And somebody asked this question. It was an important question. I thought it was a really good one. They saw me sell GSAT, G-S-A-T, and today it gapped open. And the answer is I didn't have one share when that gapped open. Why? Because it bored me to death and I sold it. But what is the rule, or how long to sit on a setup is possible? And the answer is, if you have a base, and a base is, there's all kinds of bases that exist. There's a flat base, and there's a cup and handle base, and there's extended long bases we've discussed, but that doesn't matter. Anything longer in a consolidation than 4 weeks or longer generally. If the consolidation is 4 weeks or longer, you pretty much can call that a base. Mini bases to me are when you see a 60-minute consolidation of 50 bars and it's just in a range. That's a consolidation, true. I don't wait around as carefully on a consolidation because the ledge of support below me is not as tight. And GSAT in that example, I have to admit, I saw the letters right at the top of the screen, AMEX, which means an Amex stock, and I was already turned off. But my point I want to explain to you here is I don't have a steadfast rule for this, but what I want you to understand is the longer the consolidation underneath you, the better the ability that a stock can handle and hold up to that area. So if I pull up DV, for instance, this is a base that's been for basically 2017. I mean, the highest peak was in the first week, basically, of the year. This has created a several-month base here. So we have 3 months of just sideways activity. And you then look at it and you say to yourself, why do I want to take, why would I stick with it even if it's not working? Well, if I understand what price is doing, let's say, and I draw my supports and my resistance, and I see there's support here, and I see that there's a downtrend line here, and I see all of these reasons that are below price, okay? Then I know that this area is worth holding on to because price is above and has all of this defense area. Prior resistance of this 3 months is defending underneath me on this stock. Now, that doesn't mean I won't necessarily need to take 2 shots to grab this trade. But my last entry, I think, was that. Yeah, it was that. I took the entry right there, was my last entry, 34.30s. But long story short, the idea is you have that huge ledge below you. And that's why you sit around with a stock. If you didn't have the huge ledge below you, I have to admit that they get a little wide and loose, and the next thing you know, they're underneath your stop. I don't know that you can count on it as well. Now, there are stocks that do basically base on base, where they stack one flag after the other. And so you can sit a little longer, but just note the best way to sit on a stock for longer periods of time is because it's above its base and holding above its base. That is the reason to sit longer. If you're in the middle of some, undefined consolidation and you suddenly just think you're going to sit around for 5 weeks waiting for it, that's not me. You can do it, but I don't have a lot of faith because the base is what creates that boring period where once price gets out of there, you're just waiting for it to move because it's already above the major resistance. That is a philosophy of why I would sit, is because it's above that troubled zone. If I don't have a base, I'll avoid doing that, okay? So let's move on to the next one, which is stack layers, which are most powerful. So let's discuss which are the most powerful layers. I said in the class, the first one, number one, was always trend. Now, that doesn't fully say what I mean because trend has two places we can identify. Actually, there's several places we can identify it. But in a trend is persistent. If you think about this last few years in the market, at 2013 and 14, 13 was a huge run. You'd think 14 was the end. Then 15 came and it was higher. Then 16 came and it was a little higher. 17 were higher. Trends are persistent. They do the impossible. They keep going. They allow a stock to do the impossible, just keep rolling through everybody's opinions. So trend is always number one. Now, a trend can also come from a channel. So if you have a rising channel, as long as price stays in that channel, that's a self-contained trend. So a channel counts. So the first thing you want to know is what's the trend? If you know what the trend is, the difficulty of stacking layers is easier because at least you know already you're trying to go in the direction that the bus is already moving. It's when you're trying to counter trend that it gets harder. Some people will say, what's an easy trade? And the answer is, well, if something's moving really strong and all you need to find is a 60-minute pullback to support on a stock flying, and it's got beautiful support and breaks a trend line afterwards, and it's pulling back, let's say, to a 20-day moving average, and it's strong as an ox, that's a buy signal. Why? Because there's nothing to the left. It's strong as can be. The stock is just waiting for the moving average to catch up. The support is right there where you're buying, and it broke a downtrend line saying it's trying to move out from that support. That's all that's necessary. So stack layers, trend always number one. I will say to you, number two for me has always been support and resistance. And I'm not just talking about one bar. I'm talking about major, levels where price has found support over periods, major support or major resistance. And if you can't see those now, it's something you need to practice. You need to go on a chart and you need to go and just sit there with a horizontal line and just mark up the spot like this and watch the reactions. Look how this closed right at the low and it just ripped right back the next day. So I know that support. I don't even have to think about it. The reaction there tells me it was a hot stove. It hit it. So here's the first time it jumped off it and closed strong. Second time it comes right to it and just snaps right back. That's support. Next time it hits it, what does it do? It closed as a hammer right here, closed. So that's reading support. The same process goes for resistance. You see an area hit right here. You see it hit again here, closes low. That was a rejection from that area. Closes low here. Pulls up to it, hits it, does a doji, and then the next day, down again. So the idea of, what we're looking for. One second, somebody's writing me. The hot stove idea is so important, and that's true. So let me break into that a little further. What you're understanding is the reactions of how we're reading them have to do with what happens when price gets there. So as an example, if price gets to this support and grinds there for 4 days, it may still react, but what it's telling you is it's comfortable in that area. when price got down to this level on DV, it just, I mean, the day just shot up and closed all the way up here. This time it closed on the low, and the next day it just shot back up. Basically what it is like a hot stove. The kid puts its fingers down the first time in this case, which is this far right here, and oh, it was hot. The next time the stove got touched, it was cool enough that it could be tapped. But the next reaction afterwards was immediate rejection, which tells you it's still really warm in that area. The next time it was hit here, it was hot again. I mean, it hit it and went underneath the prior day's low. You can see the prior day right here. It went under the low and then snapped back into the range at 32.03 and then closed up here, right up here. Actually, that was minor resistance up there. So what I'm saying is we need to learn to read reactions. I say to myself that support and resistance is definitely number two. If you took away all my other tools and gave me nothing but support and resistance, I don't even need trend because it is support and resistance. If you said, Randy, I'm handicapping you to allow you to have one tool, the answer is I could trade just support and resistance. If you took away everything from me, you could switch it to a line on close chart, and I have done it, might I add. You could switch it to a line on close chart. The only problem is there's a curve fitting that happens with that I can explain later. But you could use a line on close chart, and when you hit those major areas, you could buy support, you could sell it back into resistance, you could wait for it to go outside of the resistance and come back and hold it as support and buy those long. You could wait for it to break support, show it as resistance here and short. You could do everything without having any other tool on the map. And I know that sounds cocky, but I have to admit it really is true. If you took away all my tools, I could make my living on just support and resistance. I will also add, I might have made more money because of that. And I'll explain to you why, as we make this business complex. When you think about it from a support and resistance standpoint, any of this, you start to realize, let's take a different stock because we're looking at the same one. Let's just take any stock. And let's understand something, what's happening in this formula. So here's a stock that found support here. It comes back down and reacts to support. If you think about where resistance is in this box, resistance isn't until you get to about here and then here. So literally, if all you knew was support, this holding here at 140, you're moving up to 167 as your target, and you're just moving your stop to break even, and you have a trade that's better than about 90% of the trades that people take. If you're doing support and resistance in the case of some of the recent price action, okay, you would have seen this support in here, right here, and said, oh, okay, I can buy this, but what's the distance to the top here? Pretty tight, I can't do that. But then you see it break support that it found over these days, and it snaps back. And yes, you need a big stop because it starts to be wild. Maybe you take 2 tries, but your target is right here. And in fact, if you left a runner, you now get up to here. My point I'm trying to say, and these are not curve fit charts. If we took the time to find boring charts, you would see this even more clearly. I mean, this whole range is support and resistance, the entire thing. If we look at indexes, let's look at, so I don't go to a chart that's going to have a mess for you. Yeah, this one has a mess in it. Let's see. This whole chart is support and resistance. You don't even need daily. You can go down to hourly and see this was support in here. This whole thing was a head and shoulders basically. And this was an inverse right shoulder, and it had to get up here. Once it got over there, it faked you here, but then it created support here above it. So you could have gone long here with a stop right here. This long here with a stop right here, okay? That may have been 10 points and it's produced 80? I don't know. You know, we're dreaming if you think that this won't work. Support and resistance, it's messy in the sense of you have to change your plan to have a little wider stop. and you'd have to write some rules. But I have to admit, and this is where I get into the funny part, is some of my best trades have been blind just like that. I have literally seen a stock, and I can't remember right now under pressure, but I just have opened up a stock and just looked at what it was. Look, this is terrible. Let's look at Momo. Well, Momo was a good example. This one had two things that would have given you. First of all, this is M bottom like right here. But this thing had a massive resistance, and I missed this. All you needed was the tap of resistance as support right here. You could have been buying 17, stop 15, and this chart gave you 20 handles. So, 20 handles for 3 or whatever the number is, you could be nothing but support and resistance. You could live on hourly charts and trading the support and resistance game. Do I do it personally? No, I'm way too ADHD, excited, want to find things, love trading the market, and so I find more complex items. But to me, trend is first, then support and resistance. Number 3, maybe fibs. I should say number 3 is channels, probably channels. But this is what I like, meaning whatever you like, you'll start to pick which ones you want to put as a priority. Originally, when I was building the class, I actually thought of defining and saying, here's the setup. The problem with that is it didn't even work for me. See, I had Dan Zenger sitting right next to me who had millions and millions and millions of dollars in trades a day, and I couldn't copy him exactly. It wasn't me. You have to create this based on your own personality. I have never once taught something to someone where they did it exactly like me. It's very hard for us. We're not built that way, especially because after 2 or 3 losses, you immediately question whether it's real, and you jump onto the next thing that you think is real, in which case that lasts for 3 or 4 trades, and you move on to the next one. So to help you with this problem, I say you choose the ones you like. I love channels. I love trend. I love support and resistance. I like fibs. I think those are probably some of my favorites out there. I have seen people use stochastics, which is the one indicator I've said that I do think is somewhat useful. Used positively as a tool. I love trend lines. So you choose which are good for you. I can tell you that all of these layers added together are what the formula is. It does not mean any one is good alone. Admittedly, I sometimes take a trade because it has one, because I'm a little impulsive, but in reality, my best trades come when I stack up multiple reasons, 3, 4, all in the same range area. And we'll talk about that further as well. So as an example, I'm just going to go over examples of problems or things I see. And I just grabbed this together because this was kind of a last minute question somebody asked. And you'll notice BABA, the last few days, BABA has been acting really good. There is a TRL, and price has been finding support on that TRL. So that's already a positive thing. Remember, stocks that hold over a TRL can go parabolic, and you've seen it happen in recent stocks. So you're holding over this topping resistance line, and you created support, which is the green line here. I also show a downtrend line, which is a green line. And I noticed this over the weekend. I had missed it on Thursday. I was so busy getting out of town for a vacation that I missed what was going to happen on Friday. And all that happened was it held support, and that was the TRL holding. It held support. The 20-day kicked price, which was fantastic. And then the downtrend line on Friday broke. So this was a long area for BABA. Now, let's talk about the one issue with the trade. If you had taken it, the 5-to-1 was a nightmare because the distance to resistance, although it may look small, it is at the high, so it probably will go higher. But this area was probably going to be a struggle. So it wouldn't qualify for R. Now, I will tell you, do I sometimes cheat? You bet I do. What I will do is let it jump to R, and I'll move my stop up to the descending trend line, and I pray that it doesn't come back on me. Do they come back on me? Of course they do. Whenever I push the envelope or try to bend the rules or be cocky, of course they come for me. Now, they bring the 2x4 once the market is more difficult. Usually when the market is rewarding even bad behavior, I get paid on that. And I know when I'm getting away with murder. I was getting away with murder when I told the group I was trading at 90% plus accuracy in February and early March, I believe, were the dates. And I could get away with anything. I could just press any button and they were buying anything I put even 2 levels together. It was perfect. But I want you to see why a stock has an issue. This issue is R, risk reward. You're buying at the descending trend line here, and you're already into resistance right above. In a perfect world, you also have TRLs above this. You have this one coming up into here, but that's not the point. The point is to understand if that had nothing to the left, if it had an open hole, a black hole area to the left, it would have been absolutely perfect in this case. And this happens all the time. Next one, EME. I did go long this today, so I'll show you me breaking rules today. Earlier today, I took this photo. I looked this thing over. I see that it's a bull flag, at the bottom of a massive pullback. I look left and say to myself, if I can get out of this box, this trading range, this thing is in great shape because there's no real support and resistance built this whole way down. I mean, this could make it all the way back to $20 without too much hassle. So I look to the left and I say, oh, it looks good, but I got to get through these peaks. And I go, here's a 200-day right under the bottom of a consolidation, support the green line. Then I look over and see the 20-day has come underneath it. Now, I hate the fact that the 20-day is still pointing down. It didn't curl back up. I would feel better if that curls up and rounds under price a little bit. Why do I like that? Because the 20-day is basically saying, hey, ding dong, the 20-day is still in a downtrend a little bit. So I don't love that, but I looked it over and said 20 and 200 right underneath price. Oil has been flying from me from my live call on UWT at 17, which is trading like 22 now or whatever. So I look over and I go, I got to find an excuse. And then the next thing I do, I look over and see this descending trend line and go, and this is a key reversal. Oh yeah, I just hit the wrong button. This is a key reversal. You'll notice it comes down, closes, and then rips right back up. Off of support, mind you. Look, 1, 2, hot stove, 3. So I take a shot right above this. I didn't catch it exactly at that line. I'm maybe like 10 cents in the 1350s on a few accounts. And today it got all the way up to the green resistance line up here, 1420s. And I just said in my private feed, guys, I pushed it and I moved my stop up and I can't wait to move it up here because I'm breaking rules. We're not even 5-1 on this darn thing. I was using, 50 cents or 55 cents, which was a stop under support. And we're coming into resistance already. So I'm moving my stop up. I'm now at like 17-cent stop. And once it hit that level, I said, I'm moving my stop to break even because I knew I was kind of breaking my rules to get it to work. But I also know I don't want to buy a breakout on oils. I don't know if any of you have experience on trading oil stocks and oil-related stocks, but they are nasty on breakouts. They are not easy. So I tend to be on oil-related stuff looking for pullbacks. That's why I bought UWT when it was, beat up pretty good. Then again, I didn't size it correctly. So I tell you my complaints when I make mistakes. But this is multiple layers. You have a 20 underneath price, right underneath price. You have a 200-day right under price. You have the bottom of flag support, which I've said to people multiple times, I love buying the bottom of bull flags. Why? Because it's support. And there was a prior mini trend in this case right before it that moved up. I prefer them in a strong uptrend, but this one wasn't. In this case, it just had that opening void or whatever to the left, which was an advantage. So I love buying support in a move, and this was off of support. Now, in a perfect world, do I wish this trend line broke down here at 1320 or something? Yes, because that gives me more R to get up to resistance. I don't love buying in the center of the box, but I'm also getting the backing of this 200-day and the 20-day and the major support. So I'm kind of using that leverage of those other backings to move my stop underneath them and see if it's going to work. Once it starts to work, and I noticed the stock was up like 6% on the day, I moved my stop to break even and said, if this whole day fails, I don't need to be figuring it out. I already have a position I took long last week. So I'll worry about, finding another entry. Now, before I go on to the next slide, I just want to make sure, can everyone hear me clearly? Type yes in the box. Otherwise, I think I'm talking to myself. Okay, good. Okay, perfect. So I hope that makes sense. Somebody asked me today a really amazing question because I didn't make this clear. And, like everything, guys, I have my faults because it's like explaining this, what is going on in my head. Sometimes that's difficult. Dan could never explain his trading to me fully. I had to watch to understand. But what I can tell you is the layers that I look for and backing, but really the layers, you want to find them all in the region that defend your trading idea. So what I mean is you could say to me, well, Randy, this also is a pullback. It was only a minor pullback and we're in a strong uptrend. Well, that may be a backing, a reason why the stock looks good. That may make you feel better about the stock. But that isn't truly a layer. A layer is something that is within the stop distance range that is defending your reasons why. So within the stop range, there's a 20-day. Within the stop range, there's a 200-day. Within the stop range, there's support. Within the stop range, there's an uptrend line. Whatever those things are, all of those things collide in the same range where your stop is. That's ultimately what layers are best. It's best when you can rub those things together all in the same range. Why? Because all of those reasons are different kinds of traders that will be there to protect you and behind you. So if it pulls back and channel traders don't defend you on a trend line, the support people do. If those people don't, the people who trade a 200-day are going to try to show up holding the 200-day. If those people don't show up, the 20-day people who have tried are doing that. If those people don't show up, maybe when it pulls back to the descending trend line it broke, where that market, that market broke out from, it comes back and it finds some support from all of those buyers. We're stacking people to stand in the way from us getting burned. We are still going to get burned. For some of us, we're going to get burned 60% of the time because we're not proficient or really good with layers, or we are forcing things, or we're having a bad streak. And for some of us, we're going to be wrong 30% of the time, and we're still going to not like being wrong, but the numbers are high enough where it keeps our psychology good. The truth is, it doesn't matter. You could be wrong 70% of the time and still profitable if you accept the holy grail, which is math. The reason why I talk about math so much is I just had one of my students today in the private feed write me a message and say, which I'm not going to divulge any private information, but said to me, Randy, I cannot believe what my Edgewonk journal is showing, because he's using the journal that I suggested. It shows all of these little tiny losses and these two winners that I took, and those two winners eat up all of those trades that didn't work. And the answer is, that's the Holy Grail. The Holy Grail is not everything I teach you here alone. The Holy Grail of this is also accepting that with all these tools, the more picky you are, sure, your accuracy will go up. But even if you don't have the accuracy, the Holy Grail is the math. If your winners are large enough compared to your losers, it doesn't matter if you're wrong 90% of the time. I could show you a system to make 50% a year being wrong 90% of the time, but you'd have to agree that every time you're stopped out, you take your stop, but every time you gain, you have to go for the gusto and let it run with the current trend. If you do that, the big winners can show up. And if you did a lot of, let's call it, filtering to your watch list, only things in a strong trend, good sectors and all of that, ones with earnings, you suddenly could find you could get some really big hits. Accuracy is only one part of the formula. The journal I said was Edge Wonk. They asked me to be an affiliate to sell this thing, and I refused because I'm not trying to collect money on this stuff, but Edge Wonk, EDGEWONK. They are German guys that built a journal, and the reason I like their journal is you cannot automatically, or you should not, automatically update and add trades. I know I used to have the one where you press the button and it imported your trades. That is not what will help. Importing your trades will not help. We're not looking for financial and tax data. We're looking for the emotions of when you had to enter the trade, what you were thinking, what you were using, did you jump the gun? Did you wait too long? You know, we want to talk about the experience points of what's going on here. And that journal is good at kind of allowing you to enter in mistakes you're making. That way you can see in your trading what's going on with your decision-making process. You also will find certain things that aren't working, which is why it's very important to track or look at it. And it's also important, like Van Tharp says, and Mark Douglas, you can't just change the system because 3 or 5 losing trades. You have to get together, 20 samples and then say, what little tiny tweak do I need to make to improve my odds here? What little tiny tweak do I need to make? You're not going to make wholesale changes. Imagine if Coca-Cola, every time they had an ad they had to put out, they completely wrote it the next time completely over and changed their logo. They'd have no brand. They take the logo and they've improved it. They make a slight tweak. They add a few more bubbles, a little bit more shine. Next one they try, they do it again. They do some, market research. People hate it. They make the adjustment back a little bit. They keep tweaking and tweaking and tweaking until you get to the point of where you can see results. And then once they've got it down, they make minor tweaks. Rolf at Edge Wonk is fun and interpreting guys to talk to. Please ask him to keep working on interfaces for trading. They are really. Yeah, but we don't want interfaces, and I'll explain to you. You do not want data input at all. You do not want data input. I was just saying this. You do not want automation of input. You want to force yourself to enter each trade one by one and answer questions. Did I rush this trade? Did I have my layers? And did I exit early because I couldn't wait? Did I hit my target? Or did I exit early because I couldn't wait? And then did it reach the target afterwards saying, hey, dummy, the plan was fine, I'm the problem. You cannot automate this process. I'll be happy to give you many journals that automate it and are better than Edge Wonk. There are automation tools to do this. I've had several of them. You don't need Edge Wonk for that purpose. The idea of why I have used Edge Wonk is whenever I struggled and wanted to look for a reason why a trade, I was able to suggest that tool because it forces you to answer some questions. And whenever I've used it, it reminds me the same things I generally know now, which is stop predicting and just react. Stop trying to, take the money early because you're worried what's going to happen. Let the trade play out. And for over trading, sure. But I want you to force yourself to have to answer the truth is what you are going to find. What most of you are going to find is you cut the winner short, you hold the loser too long, or you cut the losers and the winners too quickly. You have too small of a stop, or you rush the entry without having all the details, and your reason for trade written down will be someone in chat said the name. Or the next one will be, Dan said he's long. And you will start to look in the mirror and go, hey, ding dong, that's not a reason for a trade. How many of those do you need to know that that's not an acceptable trade set? And you will learn from your own journal your own mistakes, and you will start improving yourself. I cannot do this piece for you. This is why I said early in the class, I could give you all the tools in the world. And if you don't believe in simple math, which is risk reward, and you don't believe in the psychology part of it is huge, you will never get it. Psychology is so enormous. I've shown you myself weaving in and out of traffic, finding ways to work around my own problem brain. Why do you think I have sight positions? Why do you think I have to move to break even so quickly? Well, I mean, all of this is based on my own internal flaws. You will have to accept that. But this will tell you what your flaws are. Don't ask for a broker import. You don't want one. It is the end of the product for your needs to use at that point. At that point, get Green Trader Tax or one of those programs and download all your records, and you'll have your tax data and your gain and loss. We're not talking about gain and loss here. We're talking about how to learn to trade and improve our trading. So I gave you a couple of examples here. Next one, trade less. We're not supposed to be trading more, it's less. Some of you will say, oh, but I need more setups, more. Guys, if you're using 15, 20% of your money in one trade, I mean, remember, if we're using 1% risk, but the stock is expensive, it's a $200 or $150 stock, you're running through your capital pretty quickly, even if you hold it to 15, 20% of your account. You only can hold 5, 6, 7 trades, maybe 10, depending on the trade size and your skill level. You may only have 7 trades. So I am saying less, not more trading, less. Look around and force yourself to have impulse control and find the best you can. You will miss trades every single day, and you will have to look and go, oh, if I had taken that, I'd be up $12. And if I had been taking that one, I'd be up $36. That's never going to stop. I have that happen every day to me. I look at 500 charts, and I guarantee you I'm going to go past 50 of them that I missed some massive move on. It'll never end. I don't have enough capital, nor time, nor layers or belief when I looked at it to take and put the money up on every one I see. And sometimes when I do see it like that, that means the market's about the top because there's too many things that are all at the right spot. That means I'm looking for the 2x4. So less is more. You have a million potential setups in a month. They're endless. They're everywhere. Stuff is lining up constantly. We miss 95% of what's good because we're so busy in the day. I am an example to you of where the impulse control, the ADHD thing is a bad thing. If I didn't have that internal push-pull, I can tell you my results would be much higher. The guy who taught me, along with Dan, have much higher return than me because the guys Dan has no impulse control problem at all. He is stone. He has no feeling. Every stock could be up $50 and Dan could be completely flat, and Dan would say, okay, no problem, I'm going to go golf for a little while. He doesn't give himself any guilt trip. It is what it is. That's how he's built. Am I built like that? Not a chance. The other guy who traded me taught me futures, no feeling at all. Next trade, knew that they were endless, knew they could come up in any shape or form. They would form daily, wasn't worried about it, on to the next trade. So for some of you who fear, well, that means there's not much to do, the answer is homework provides trades, not activity. And so I don't realize this until the market changes. So let me already tell you that I need you to see this flaw. When we're doing well and I'm being rewarded for even trades where I kind of pushed it or got away with murder, then I know the market is so good that I can do pretty much pull even 1-2 layers, and I know if I'm in the right spot, I'm going to get paid. As the market gets tougher, I know, I look at my last 4 trades or so, and I go, last 4 trades, wow, those were 2 instant losers, and this one's trading near the price I started with, and this one's up a whopping, $3. And I look over and I go, it ain't the same as it was before. Holy geez, this is, I'm struggling here to get anything to work. And I then realize, whoa, Randy, take your foot off the gas, put it on the brake a little bit, and let's start digging a little deeper. Stop being so aggressive. And usually I will have been so used to being rewarded for everything I touch, and so lucky because the market is helping me so much, that I will take some pop shots. I did it right here on AAOI. I did not own the stock for this big drop here because I had gotten out over here because I bought a FOMO entry when it pulled back in the break of 56 right in here. And then it didn't act right, so I dumped the stock and took a loss in here. I want to say, I forget how much I lost here, but I had been sitting down here in this area waiting and kind of thinking, oh, I'll try to buy it. And I forget exactly my buy. I think it was right here when it found support in the little triangle, and I bought like right in here, and I tried it, and the stock proceeded. I gave it like a $2 stop thinking, it's going to hold the channel. It's got to hold the channel. It didn't hold the channel, and I lost. Now, with all due respect, would I have taken that trade if the market was super? The answer is yes, I get paid on all this stuff. When the market got harder and the stock was screaming down, and is that multiple layers? The answer is no. That's outrageously aggressive and predictive. Yes, it was a break of support. Yes, I can or right at support. Yes, it was an uptrend line I could predict. Is it an easy trade? No, I was asking for favors from the market. It takes me sometimes a few stupid things to finally go, hey, ding dong, your account ain't going up anymore. Time to back off and take this a little, more, less aggressively. And so if I was more, let's call it disciplined, like a Dan, I would just sit and wait for 3 to 5 layers always, never touch a button if I didn't have that many. And yes, it would be more lame or boring, but there's more money doing that. And so I have some students, and I want to say this, I have some students that behave exactly like that. And they're the ones with the best letters of anyone in the class. The best letters I still get are from guys who literally said, I've been doing this for 15 years, and all I did was do this. I'm buying off major support. I'm doing this. I'm doing that. Just simple and waiting for just those, and it's working. And the answer is they're smarter than I am in some cases because they had the discipline to just sit and wait rather than, want to trade. And I still want to trade, which is a failing, but I told you this is it's a fight with psychology. Now, after trade less, M bottom, we're going to discuss the pattern because everybody wants to turn this into a pattern that it isn't, so let's discuss it. Yes, TWLO is creating a potential M bottom pattern. The answer of whether something will become an M bottom is when you bust these 2 peaks, 1, 2, 1, 2. An M bottom is a deeply dug trench where a double top forms nice swings, where price is rejected clearly on those swings, and everyone is giving up. And what happens is when you bust this double top, all of the shorts up here have to cover. All of the people long start chasing because it looks like it's breaking out of a base. They don't realize a base requires a 20% uptrend generally, but anyways, they will start chasing and the thing flies. So yes, I am looking for an M bottom. That is what the pattern is. People are trying to curve fit them in, but that's what an M bottom is. Deeply dug trench. An M bottom couldn't be, after it makes multiple legs up here, it couldn't have formed up here because that means it was in a mini uptrend when it formed. That means that people are sitting and defending a new uptrend. It needs to be beaten down. And there can't be many believers anymore. In fact, the safest guy or girl in this trade should seem like over the tops, the short. Now, you'll notice this has an uptrend line and there's a downtrend channel. And in this case, price got to the bottom and we had a gap up in TWLO. And some people in my private feed already started this trade. I actually hadn't started it till today when one of the people on the private feed notified me that it had made a 2B, basically, was building a 2B on top of the prior resistance. And so I took a feeler. And the reason feeler is the word for it, or psychological position, is because I don't want thousands of shares of this thing in a self-contained downtrend. Look at what it is inside of. It's in a self-contained descending channel. The trend is down here. It hit those two peaks. I love that it's down here for the M bottom, but it's in a downtrending channel. That means until it breaks out above this channel and holds this as support and starts to go, this is very clearly dangerous as can be here. So a feeler maybe. Now I will tell you what made me take a feeler, and let's talk about psychology. What made me take a feeler is Restoration Hardware. So let's talk about psychology. This was an M bottom that I had been sitting and waiting for an alert. And on earnings, they decided they were going to gap the M bottom. So being that this M bottom was one that I wanted badly, and I was sitting there with bated breath for it to pull back and it didn't, I'm sure I pushed it a little bit when even considering TWLO. But that's the psychological problem of being a trader, which is why I had to invent a sight position, which is basically a position that's less than or about 10% of a normal position, to just get myself to stop, have that nagging feeling like I'm going to blow it. Now, Dan never used the word sight. Dan never said to me a word about this thinking, but I did notice when he was buying, he would start out and buy 10,000. Now, 10,000 for you and me would be like me buying, I can't even explain it to you. It's such small money. It's a joke. Now, for some of you that don't understand, on 10,000 shares of Amazon, that's different. But if we're talking about him buying, 10 of a $40 stock, that is a rounding error for Dan in size. So I would watch him and he would go and scale his first. He'd say, Pete, give me 10 of that. And he would chop away at it at 200 shares a clip and load 10,000 shares of that stock. That was just the sight position, the feeler. He had his hands on it. If the stock acted great, he would start adding to that. It could be 100,000 shares or more. But if it didn't, it would stay at 10,000. Well, that's my sight position description, was what I've learned from Dan out of that experience. And he didn't have a term for it, but for me, my reasons are different than his. His was because he started to see action he liked and he wanted to track it. My reason was my head was buzzing and I didn't want to blow the trade and miss it because I liked it. In this case, I couldn't catch RH, and it still bothers me every day. And if we come back to those two peaks as support, I will be long Restoration Hardware, period. I'm not thinking, I have it planned. So I have an alert in TC2000 for exactly that instance. Someone sent me this chart asking on TLT if that was an M bottom. No, we can see very clearly the difference. This is basically a descending trend line, mini consolidation area where the TLT is trying to break out from that area. It is deep in a trench, I will give you that, but I don't have clearly two well-defined rejected peaks. I basically see a line of resistance at these peaks right here. So I consider that if this resistance turns support, sure, it could go up, no problem. But this is not an M bottom. I need you to see clearly the difference between the two. Someone asked me where volume matters. And volume matters in specific places. So I'm going to show a chart that explains, because some people think I don't use volume at all. And the answer is I use it in areas where Dan does, and I use it in areas where I find value in it. So as an example, here's a chart of Goldman Sachs, and you can see resistance where it found a little tiny resistance area. When Goldman broke out of that area, you could see the volume just exploded. I have it grayed out what the average is. So all of this bright green is above the normal daily average. Huge amount of volume, whoosh. Second time, right here, look, whoosh. All these green shoots coming out up to here. Now, there was a rising channel here. I did the red line. You could duplicate that up to the top. This is a rising channel. And when it broke here, right afterwards, look at the sell volume show up. So this was leaving a consolidation. There was heavy selling. This was leaving a consolidation. There was heavy buying. So where do I use volume most commonly? When you're trying to leave support and resistance in a range, or when you're reacting off of major support or major resistance, not every little tap. But if I'm buying off of a major support level holding, like a hot stove, I'd like to see some volume come in to show me they see it too. Otherwise, if you're not using it for support resistance or leaving consolidation like a breakout, often volume will fool you. What you can tell from volume is as it starts to show less accumulation or more accumulation. So for instance, you'll notice that as this stock right here was climbing up here, there was nothing but volume here and here. The next time it lifted up here, look how quiet the volume is. So it made this higher high on less volume. I do see that. And there had no selling volume in here, none, because it was still at support where the red line is. Once it broke, there's your sell volume. And then the next lift up, there's nobody here buying. They actually sold right here. That big inverse hammer or gravestone doji, whatever you want to call it, was a rejection. So what you need to understand is I do use volume. I just use it sparingly where it gives information to me. I used to read every wave and go, well, you know, the volume on this one is so high, and then this one, it doesn't seem to be as many big volume days. Well, the thing just ran like a bat out of hell, and it's still climbing on huge volume. Stop trying to decipher everything and just read what price is saying first, and then volume. I can tell you, Dan will tell you volume is important, but price is always number one and number two in his brain. He may not say it that way, but I have seen him trade stuff where the volume was awful, but he saw something in price that told him something's going on here. I need to watch it. That you can layer these two together. Now, next one on volume. I also, even though I did not catch this trade at all, I thought it was a very good example of showing when volume provides clues. And some people call this, I believe, from Canslin and the rest, they'll call it skyscraper volume or you know, volume, whatever it is. These extreme volume days are often an indicator. When you see out of nowhere an enormous volume day like this, in this case, it was a gap, an enormous volume, that doesn't necessarily mean it is an end of a move. That is often the beginning of a move. So you need to watch that behavior. They will come out of nowhere. There will be some stock that's been basing for 6 months or whatever it is. It'll have a huge day and you'll be afraid to buy it, but it'll have it on 20 times normal trade. And that stock will then be moving for a year. And the answer is those green, powerful, huge volume bars show a massive change in demand and can be a clue going forward. Now, that doesn't mean every trade here worked out. In this case, the first one maybe gave you a notice here. Beautiful flag, breaks out, stays above your cost here, climbs up. Next one, gaps up, huge volume, climbs up, rising trend line, boom. Key reversal right here I can see, and it pulls back. You're now under the cost of that last buy, but reading price, you understand why. Next one, Right here, green volume for the days coming up to it, warning you, big gap, powers forward, never undercuts this nice bottom of the flag. That's buying support right there on a flag. Huge volume climbs up, climbs up, climbs up. Next time, big volume comes in somewhere around here. I believe that, it's hard to align, but right after that big pullback. So you can see how big volume can be an indicator. Some of you will run a scan saying, show me any stock that had a 5 standard deviation difference in volume today over the last 6 months. And that will probably put you into some major stocks to look. And it always starts out like that. Many of your best stocks will start out with an enormous sorrow. They will start out like this. Huge volume, huge, huge, huge gap, huge volume, huge gap. That is a recipe for strength. And you can see what happened to the stock. If you had even bought the high of that day, the stock is up 145% since then. Okay? So you need to understand that big gap and big volume are indicators of underlying huge potential strength. Next one, fib examples. I was asked about fib examples. How do I use them, draw them, whatever? And here's an example. In Apple, I had this buy at 112.50. I did not use this buy. I bought it at 112.50, which was the right shoulder failure, which took me to 120. And then this guy sold it out because I was bored and didn't want to go into earnings, in which case I'm very upset. So let's stop there. I took this from one swing to the next swing, and it shows me where the 50 and the 61.8% fib is. That is the area. It happened to also be, in this case, the 200-day. So you would have said, I'm in the fib ratio between these two numbers. The 200-day responds. I go down to a lower time frame, find more reasons to take my entry, and you have a long in there. I use 50 and 61.8 as my fibs, and I use a negative 27. Well, that's actually wrong. Ignore the extension. It is totally wrong. I think I miscoded that. I don't really use it. Next one, the last pullback on Tesla. Tesla was a right shoulder failure. If I had not day traded out, it was a long story, but I was in a mood, and this was a long from the right shoulder failure all the way above the head. You should have taken a good chunk here, and now you're riding free. But so you understand, the last pullback on Tesla, that big down bar, that was a 61.8% retracement. That's all it was. If you had found other layers in that area and you had seen excuses on a 60-minute chart or a 30-minute chart or whatever, I could have gone along there and I could have gotten a free ride to have scaled some and let this run go also. But that is a simple fib. Bottom to the first swing high gives you the first pullback. That's only a layer. We didn't choose just based on that, but I'm showing you how I draw them. Okay? Next one, AAOI, and we're going to discuss this because it failed. Bottom of the gap, up to the high of the gap, pulls back, 20-day, strongly trending. Notice strongly angled. And the exact 61.8 right there. There's two layers right there for a long on AAOI, and that took you from 46, whatever it is, to 49.20, whatever it is. Now, I tried to do that again. I drew the fib from here, dragged it up to the highs here, and it was supposed to stop. And I used that as a layer along with the bottom of that channel. Didn't work. Trade failed. Was I a little aggressive? You bet your butt I was. But it didn't work. So I'm just showing you, it doesn't mean it has to work. It's a layer. In this case, you would have said, God, this is a strong stock. God, is this a nice layer that it's a fib? God, is this a beautiful trending 20? Okay, this area is pretty good. I'll give this a shot. But I still need a layer for the entry, a little descending trend line break, maybe some volume, something to tell me this area was reversing. So that's fibs. I use the 50 and the 61.8. I do not use the extension, even though I had it on the page. And this is not because I'm hiding something from you. I just don't use it. There is a proper extension. I will tell you what it is if I can figure it out, but I have not really used them. 2B. Somebody asked me what 2B and a 2T are. Very simple. Takes 1 second here. Bottom created, pulls back, undercuts the support, creating a double bottom, but the second side is lower than the left bottom. Why is a 2B different than a double bottom? It's a better double bottom because the second low undercut the first, which killed off weak hands. People like you and me that maybe put our stop a little too close on that bottom. So they go underneath it, they climb underneath it a little bit and hide, just underneath it. They find all those stops and boom, right back inside. That's a 2B. The same goes reverse for a 2T. 2 peaks, second peak higher than the last peak, whip out a few more suckers, and then they drop it. And yes, I am one of the suckers that get busted in them. There's no way to fully avoid them. I try not to put the stop like 2 ticks underneath and kind of hide deeper and let it play a few games in there or look for a flip or whatever it is, but you just get hit sometimes. It's part of the game. Next one. Why is index trading more advanced? This question came up like on the first one, and I didn't want to address it because I hate this discussion, because if I'm already confusing people with too many ideas and too much jargon, let's make it 100 times more difficult. Remember, when you're index trading, you're looking at 3 indexes, but those 3 indexes, let's say from futures, have 2 time frames. They have all hours, meaning including Globex or after hours, and then they have intraday from market hours, okay? So you have real-time hours, and then you have those after-hour periods. Then you have SPX, which is the index version that people look at when they're looking at their charts very often. And then you have SPY, let's say, which is an ETF that people very commonly use looking at the S&P. Or in the case of the NASDAQ, it's the QQQ, or TQQQ is the duplicate. But you're now not trying to decide 4 layers or 3 layers on one chart. While you can make it more complex because it's smart on a stock chart, because you can look at the sector, which I'm suggesting it's a good idea. You can look at the sector and say, wow, my sector has a good chart and my stock has 3 layers. This is even better. That's great. But with an index trading example, you have to look at it on 15 charts at once and determine if the layers are all stacking amongst all those charts to make a decision. It is much harder to tell you how to do this on an index, because now you're stacking layers and trying to find alignment across all of those indexes. Now, I did have a chart from today that I could use as an example. And it happened today where I actually covered a hedge and then put it right back on, and some people didn't understand. But I'm going to explain it. I had a chart going for the ES futures here in the center. This is the NQ futures and the TNA. Which is the Russell. I don't use TF futures. I don't use anything on the ICE. That's a whole nother psychological discussion, but I lost 6 figures on the stock ICE and I never will touch it again. Anyways, here's the VIX was climbing. In this case, tick was dropping, advancers, decliners dropping, the decliners are increasing. That's not the point of this chart. What I want you to understand is the ES tried to break out here this morning. The NQ or NASDAQ had this beautiful open area here where there was no support and resistance, which it was trying to break out. I actually was more excited about the NQ here, thinking it may go. I did not buy it, but I knew that it was time to maybe cover a hedge when it started to break out. I knew this was resistance right here. I knew this was a 61.8 fib. I knew this was resistance, those 2 peaks here where it had rejected before. And so I knew it was resistance. Now, I covered up I had a TZA position, and it went over the line, and it held over it, and then it lifted up off of that. And I covered my hedge at that moment. The next thing you know, the ES reacts and rejects back under the line. The NQ falls underneath the line also. The Russell or TNA falls under the line, and I'm watching, and the VIX is now climbing stronger. The decliners are increasing, advancers are falling. This is rejected, this is rejected. I'm now saying I have to add my hedge back on. So I did. What I'm saying, though, is this is only one screen of my 7 that are running at this moment. And I'm looking across all of these and saying to myself, this all tells me what the index is doing. That's a harder trade to teach somebody at this level to look across all those time frames and make all of these evaluations. What happens if 2 of those were at resistance and the other one had room to move up another 6 points on Russell? Well, maybe the market on the other 2 would get pushed higher as the one that had still a magnet area was going to pull itself toward it. You don't know that yet. You're not necessarily at the level of reading price. So I avoid this discussion until you've had enough practice. Once you've practiced enough on individual stocks mixed with their sector, you can then worry about having to put up 7 charts for each index, going back and forth, looking at hourly and daily, and looking at the ETF, and looking at the SPX, and then looking at the ES futures and the after-hour futures. You can try to align all that. Admittedly, I don't always trade it because the range hasn't been good, but I use it as my alignment. I use the general market for alignment, meaning I try to pick trades in the direction of the alignment. I wasn't taking any breakout trades today, even though it was killing me. Yes, the first stock I saw out of the gate today was BZUN. My watch list caught it immediately. Second one was Momo, I think. Third one was, oh, what was it? Geez, now I forget. Momo, BZUN, I forget. But all of the big movers today, like the really solid big movers today, immediately came up. I mentioned them even within the first probably 10 minutes of the day. I knew what they were. But I have to admit, I just had to sit there and go, man, I'm not going to pull the trigger because we're right at resistance. And it started to go through, and I was like, oh, I'm going to miss all these breakouts, but maybe it's going to break out. That's part of the headache, guys. I just sat there and missed any attempt to take any of them. Bob, I wanted so badly because I had missed it. I had been out of town in Disney, and I missed that one on Friday and Thursday, noticing it. And so I wanted it, but I looked at this and said, oh, these are all at resistance. Next thing you know, it rejects, and the idea of the hedge is back on, and it makes sense again. The idea of what I'm trying to explain here is you don't want to start looking at 12 charts to figure out whether a trade is good or bad. Start out with a sector, a general, maybe a SPY chart, and for the general market, and then just stick with your stock, the most important weight to your stock. Because even though 50 to 60% of the movement of any stock is the general market or sector, I still say it's easier to try to focus on a name than it is to try to look at 12 charts and figure this out. It will only make it more complex and difficult. In time, you'll get there. Index market alignment, all I just wanted you to understand is you're trying to buy a breakout when the market is in a mode where it's held support or it's breaking higher on strong volume or whatever your reasons are. You don't want to be up against a huge resistance level starting breakouts. Today was hard because of that. You want to align your market. Next one, why multiple time frame? We're almost done here, guys. Why multiple time frame? Pretty simple. We don't want to buy something without looking at the shorter time frame because we need a decision chart. If we're looking at EMES here and we're seeing that we want this stock because of all those reasons I gave you, we then need the shorter time frame chart so that we can kind of refine where we're going to take the trade. In this case, if we don't have that, we can still determine that we want to take it off of 13, 14 or something here. But it's better if we have more proof on the shorter time frame saying, hey, I see what you're looking at, and I actually see it all, and the market sees it. And so we're together on it. I'm moving in your direction, telling you that I see a little bit of what you're seeing. This is just a little bit of confirm saying they see what we see down here. That's why you need the second time frame. Actually, you're best using 3 time frames. I actually look at the weekly very often just to see what it's doing. And not that I care about a 50-week moving average, but at the time of when this was happening, on my next screen over, I had seen, and even though I don't use the stochastics visually a lot, you can see it's buried down here. You can see we're in a nice rising trend line right here. And I look over and it's holding up right here. And I go, okay, that's one good layer. The stock is holding up. It looks good. Now let's go to the other layers that I can find. The time frames produce more information. The shorter time frame does not produce massive support or massive resistance. The shorter time frame does not create massive trends or persistent trends. The shorter time frame is the alignment, little confirmation signals that tell you I haven't lost my mind and I'm not curve fitting. Next one, first mouse and second mouse. Still get people who ask me this. Somebody said, well, what do you mean? The answer is the first mouse immediately sees a low and jumps to it immediately. Just the minute they see a low, they want to grab it right here. Actually, we have a good example of it right here. They immediately see a low area and they go, oh, it's undercutting the low. I have to jump in here. And the second mouse knows that they will often come back and retest things. And it did. The next 2 days later, the next day was a doji, and the next day it came right back down and tagged it. And all those people are disappointed or scared and probably sold their shares, and it never even undercut. The second mouse theory is just simply saying, I don't want to be first. I don't want to be first to a new trend. I don't want to be first to the pullback. I don't want to be on the first leg of the bottom of something. I want to let those first people think they got it, let them get a little disappointed, and I'll take the second signal because I'm tired of being the careless, Evel Knievel character that's going to try to pull off catching a bottom. And so first mouse, second mouse simply means we are always better off with more confirmation. I'll give you an example. And Dan does not buy without confirmation. He'll tell you the one example when he doesn't, because he likes to, tell you the example that he would always kind of like throw me off. But I knew the difference. If the first signal here on TWLO is the fact that it's holding this little area, so let's say the next day its bottom was here, that's a first signal. That's a good signal. But if the next day it creates a double bottom over resistance, that's signal 2. This is actually a confirm after the first signal telling you that they see it too. Does that mean my stop may be a little larger? Absolutely. But it also means that I have confirmation telling me they kind of see what I'm seeing. Did I have that on AAOI? The answer is absolutely not. And that's why I got burned and lost on this thing. Now, I only did it on like a 10% position, but it's laughable because look at this thing. This is first mouse. It came down and I buy it. It has a beautiful little descending line here, and the thing just tanks off. Hello, I could have just waited for a descending trend line and tried to be the second mouse, but the hero here had a fib and the bottom of the channel and decided, oh, I'm going to take it, and it fell through. If I had been second mouse here and acquired it, I probably would have been buying here, but we probably would have got it moved. So, yes, and a little H pattern, yes. But again, this is the impulsive problem of psychology. You will all lose because of your psychology. The answer is, if your winners are big enough, you'll supersede any of the problem that can happen. But I just want you to see what I mean by second mouse. If I had been second mouse in that case and not been, egotistical and figured I'm going to go and predict this and the rest, which again, I show my errors so you could see, I would have, I would have been embedded. Yes, Chet just said, Gilead has killed off the entire mouse species. Right, and I'm not looking at the chart, but I'll look real quick. I show you guys my faults because you're all going to do them. I mean, I hate to say it, but nothing's unique about my faults. They happen to all of us as traders. Oh, well, this barely can find a second mouse. I mean, here's an example of a second mouse. First time it finds support, next time it undercuts, it comes back inside of here, you buy it, whatever. If you thought this had some other reason, the stock goes up, makes it to the Virgin mid area almost, and then falls back. This stock, the problem with this stock is pretty simple. This thing has been horrible trend. This thing has got such an enormous strong trend. There's not a buyer to be had. This is like VRX almost bad. I mean, there's just nobody who wants the damn thing. So yes, you're right. What would change this stock? I think we should look at DDD to show you an example. What finally happens on these stocks that go down for years? I'm going to just show you what happens. There's a couple of things that happen on these that go down for years. And I screw this up all the time, and I just want you to know. You want to catch the low. I know that beating heart feeling where you want to catch the low, but what normally happens to these things is the size and scope of the bottoms they create are directly relative to the size and the distance of the fall, the time of the fall. What I mean by that is they will go down for like years. And when they finally bottom out, they will base for like ever. You know, could be basing here for a couple of years after they bottom out. This long period, if you only had a 2-month consolidation, it's not the bottom generally. That doesn't happen. What happens is the amount of players here that have all been decimated, it takes entirely new people, entirely new earnings, entirely new believers to come back in. Soda is a perfect example of a recovery. This one had a massive decline. It came down here and made it was in this range for August to May, in this period. It got its first leg up, pulled back. This is highly unusual, this strong of a move back up. Most of these stocks that do this, what's another one like DDD? I'm trying to think that had most of them, they will sit. This is more normal. Huge decline, base forever. Finally, they come out someday when something happens. They can base for up to years off the bottom. And technically, these are not even really bases because you have to move up 20% and hold to get a base. These are just rolling out the lows for potentially years they can sit. Soda is an anomaly. They don't normally do that. Now, if you had to have Soda, and this is a weekly chart, we can go over to Soda and realize, well, it gave us some clues. First of all, here's our bottom. We didn't want to buy that, even though we can see that was support. But what we did get is a gap and a takeout of a pivot. And we got some consolidation. So if we believed and wanted to be second mouse, we could have found this double bottom, for instance, right here, and bought here, stopped here or something, and said we're in it. Next one we could have bought was a third basic signal. Descending trend line here. Oh, hell, this is beautiful. Look at it climb on the trend line, holding it. You know, long underneath here, stop here, long, the stock gaps up, keeps going. We can find ways into a trend or into a trade. It's pushing for that first place. It's trying to fit it and make it work. That is a mistake. And I just told you I make that mistake. Why do I do it? Because of FOMO, because of fear I'm going to screw up or fear I'm going to miss. I have not gotten rid of that. The owner of my company and the guy who I learned from has none of that. He could be down $1 million and he wouldn't cut a position at all that day. I could be down $10,000 and start looking around, or $20,000 and I start looking around. What the hell is wrong here? I got to go and start looking. What did I do wrong? I'm already looking for something to cut because something's not acting right and my account is dropping. He's sitting there with $1 million not missing from the account, and he still is holding on to what makes sense. He doesn't have that emotional switch that goes off in his head that says, this is painful, something's wrong. I can tell you, once I'm in 5 figures, I start noticing the pain. So, I definitely am aware of my own problem. It's internal and everyone's different. For some of you, you'll be able to size much larger than I am. I have a buddy of mine, I told you about him before. He's a total gambler. He can be up or down 50K a day, feels nothing. And he may only have 150 in the account. He's a gambler. He has no feeling whatsoever. There is no tie to reality of what I look at that as being. But his brain doesn't do it. Mine, I don't like loss. I can't mentally. I evaluate. Believe me, I see it all. When I close that TZA trade, and the next thing you know, I put it back on, and I'm up $2,000 plus, and then it turns from $2,000 back into zero. 20, 30 minutes later. Trust me, I see this stuff. I'm aware the money going in and out. I have to watch my emotions. In the case of Dan, he has none of these problems. If you're lucky enough to not have any emotional problems, heck, you can buy support on a major support point and go blind and let them sit and catch some unbelievable trades doing the simplest junk in the world. But my brain wants to find ways to avoid pain and gain pleasure. And so I have to work around it. Anyways, second mouse is best. You don't want to be the person who rounds out the bottom every time. You may do that once in a while, and you're lucky if it works, but that's really a dart game. Okay, last one tonight, unless somebody has a question, but don't list them yet. I'll do a couple of questions, but I want you guys to get out of here, is scanning. We're going to talk about some of the scans and things I look for. I already told you some of the most important, which is huge gaps and huge volume showing a signal to start watching a chart for further trades. Now, some of you are looking for automation, and I'm not going to discuss automation because I don't do automatic scanning as advanced as some of you are looking for. Some of you will bring me ideas. I will, help you, and maybe I'll even use them if it's really good. But realistically, the more charts I look at, the more they make sense to me. I am not sitting and dissecting the market and finding them automated all day long. I am looking for them specifically through symbols and through, different watch lists and a couple of scans that I look at. Now, if you're looking to scan, if the market's really good and stocks are trending, I will be scanning in the morning for the stocks that are gapping up and down. In TradeStation, I can use my scan, or there's one called a hot list, and it's called gap up dollar or gap down dollar. And I will copy and paste these into a separate watch list, and I will sort them by volume so that I'm not looking at any that have really, less than 5,000 shares, pre-market. And if there's a screw bar, which remember a screw bar means, let's say it closed at the absolute low area of the day, the prior day on a bad day, and this morning I look pre-market and it's gapped right over the edge of that prior day bad bar, I'll look and think, all of those people are screwed. Even the shorts who thought they were lucky, they're screwed. Put it on my list, let me watch it. And I'll watch the volume coming right out of the open. And my buddy C-Kip made a suggestion and said, tell your people in your class, open up a 5-minute chart, even if you want, make a 5-minute opening range, watch it as it kind of trades around. If the volume is there and it's one of your screw bars, if it breaks the 5-minute high and it's got volume, go long, stop under the 5-minute low, and try to take the trade. That's if we're trending. If we're in chop, those are going to fail more often. We went from February, the idea working phenomenal, to March being more difficult. That's the market change. Now, if the market starts to get downtrending, and I've been watching some of the gap downs lately, if the market starts to gap down or we're starting to see sectors that are falling apart, you scan the dollar down list, put it into a list, see any of them that are 5,000 or more shares pre-market, look to see where they're gapping. Are they gapping major support? Major support as a gap down. Or are they doing a screw bar? The prior day was a beautiful up day. Boom, it gaps right under the swing low. You're looking for those things and you can scan them each morning and look for them. Right now, are we in a downtrend? No, we're in pure chop. And so I'm not as carefully looking at gappers every morning. I still look at the list because I want to see what has activity. if a sector like railroads like today or whatever it is, or I mean trucking today shows up, I can see just by the names of the gap, I can tell, wow, oil's strong, and wow, there's something going on with trucking today, or there's something going on in machinery. I can also see it in the same thing in the gap downs. There's something happening in certain other countries that are having trouble. Whatever it is, that's the data I get from doing that scan. So that's the first scan idea, looking for technical gaps, gapping a trend line, gapping support and resistance, or screw bars. That's one. Now I have a list of other ones that you can scan for, and I'm going to tighten this up on the private feed. I planned on doing this, and I haven't done it yet, which was to create kind of an area of some of the things I'm truly scanning for. Because when I'm bored and like right now where it's choppy, I will stop what I'm doing and do a couple of scans. And otherwise, I'm just looking at Dan's whole list of names he mentions, and I'm just going through a universe of stocks in general. Now, here are some things that you could look for, and we'll get you out of here in like 10 minutes if we can, 15 minutes. Right shoulder failures. One of the most powerful patterns I know, that was that Apple trade I showed that we did live. You can look for those. So you have to manually scan for those. I don't know of a program that's going to tell you a right shoulder failure is coming up. And bottoms, manual scanning. If you find one, you have to tell me or I'm coming to shoot you. Those are way too powerful, and people told me about RH. I didn't come up with the trade. I missed it, but I didn't come up with the idea. Neckline fake downs. Sometimes when the market is going through a rough patch and I'm seeing pullbacks, I will look for head and shoulders where the neckline breaks down below and then they snap back like hard, like a fake down under an uptrend line. Those will often be strong enough to go into the V mid or virgin mid, right into the area of the right shoulder. I have used those often when there's a larger type of pullback where I get some nice one on those. I've traded that very often in a scan when I found those. But manual scanning. Breakout back tests. That I do scan for manually again. Or if you can write a scan saying anything that has a 5-week consolidation and price is in that zone, you could look at all the bases, and if you see one like DeVry, which I showed you live, that comes back to resistance as support and holds, that's a breakout back test. Those I love. Now, here's something you can do to help with your scans. Some of you who are manually scanning will say, but that means I'm scanning like from 5,000 stocks. I cut the universe down. I get rid of anything trading less than a couple 100,000 shares a day. If I get bored and the market, let's say, is tough where everything isn't working for me, and I definitely notice that my trading is getting a little tighter, I will go into my MarketSmith, I will go into the universe of stocks, and I will limit it, let's say, to the stocks that have positive earnings, or stocks that meet what O'Neill calls as CAN-SLIM quality, which are just stocks that have, positive earnings, an ROE. I'm not going to get into the formulas, but in MarketSmith, it does it automatically for me. You could just simply say all stocks that, have high relative strength. You could write your own rules, but I will go in there, grab a universe of 500 stocks, and that 500 is all I will scan from, both manually and automatic. Why? Because it's a true statement when I say, if you limit the universe to only scanning the ones that have strong positive earnings or earnings growth or earnings surprises or whatever your formula is, it's only limiting the quality of names that you then buy from. Remember, we can find setups on any stock, including stocks that are at their lows. But if you want to make it easier, you'd rather have one with less resistance to the left. That may be just a scan of looking at stocks that are within 5% of 52-week highs. Now you'll laugh at that scan and say, oh, wait a minute. Who wants to go look for 5% above 50, between, 95% of 52-week highs? Well, let me give you an example. Let's say you have all the stocks near all-time highs. Oh, great. The guy starts the Harley behind. 1 second. So let's say you have something at within 5% of 52-week highs, and you're looking for a trade. You could go down a 60-minute, find a descending trend line on an unbelievably strong stock that built a nice flag, and simply buy that tight stop on your 60-minute, and in essence, almost day trade slash, small swing on those because you have nothing else to do. There's plenty of trades to be found by just looking at strength. Remember, there's nothing really to the left when you look at some of those, or there's a nice open area. Now, do I do that always? No, I'm spoiled because I always can find what I'm looking for in many markets. When I struggle or when the market changes on me, I can guarantee you I do stuff like that. In fact, last week, I limited my universe on my TradeStation and cut it down to some of the higher quality names because I wasn't wanting to look for weaker longs, knowing what I was seeing with resistance in the general market. I also started looking at sectors more starting the last week or so when it started to be a little more difficult. Next one, Sector Plus stock. So you can go look at your sectors in TC2000. They make this unbelievably easy because you can literally say, show me everything, where the percentage this week. For instance, solar today, I didn't like seeing that, but solar had a huge day today. And this thing's been down for the last year, the last 6 months, 3 months, 1 month. This thing's always down, and then suddenly it's up today. But you can look across and say lumber's been strong, and it'll show you all of these stocks that meet that criteria. WY, here's one. Next one, RYN, Rainier. Next one, BCC. Next one, EVA. So I will go down through these sectors and look at the components with volume. I'm not going to look at the one with 66,000 volume a day. But I will go and look, and no, I don't use candles, but I just have it set like that and didn't care. But I'll look at the general sector of what it looks like. This Weyerhaeuser came out of a massive basing, huge basing area. Anyways, I will go through here and look for ideas of what sectors are moving and get an idea for scanning purposes. Next one, bottom of bull flags. I do these common. I probably have shown since the class maybe 25 trades where I was buying the bottom of a bull flag. I do it outrageously. It's an outrageously common thing for me. Why? I love buying support. I love the fact that the flag says I have a built-in trend, kind of. I love the fact that there's a small area that if it can break out of that support, I get a runner, which turns out to be a breakout trade. And I love the fact that I can also move my stop to break even on the breakout failure without getting mauled on the breakout failure. I like those. Same thing at the top of a bear flag. If this market is weak, you will see me stalking stocks that are at the top of a bear flag that failed breaking out of them or failed the descending trend line break, and I will short. Bottom of a rising channel fake. Love when you go to the bottom of a rising channel, you go underneath, the trend line whips back in, and you try to buy off that bottom of channel. I use that. Those are fake downs underneath the channel. Same thing for a descending channel and a falling channel. If you notice, they try to break the trend line. They come out for a day, and the next thing you know, they gap back inside. That's a short. Comes out of the trend line, breaks out, falls back in. Next day, opens, top of the day, is sitting and hanging around below the descending trend line. Short into the channel, looking for the other side. I do those trades very commonly. Major support areas, support and resistance areas. Heck, I'll mark them on a chart. I don't trade this, but I can guarantee you if I had been looking at this stock, I would have put a line right there. 1, 2, 3, 4. And I guarantee you if I saw that and I've been paying attention to this stock, I could have bought this with a stop of maybe 40, 50 cents, if that. And with the rounding, I could have maybe done this 40, 50 cents. I would have looked for some options, and I would be long this. I would guess this stock moves up maybe $6 from that spot. I wasn't looking at it, admittedly. I just pulled it up. I haven't looked at this stock. But this thing has $6 in it for 40 cents or so. So I would have considered something like this. And the sector also, looks good too. And that's just major support and resistance. I'll look at that. Very long bases. This qualifies. This was not planned. That qualifies as a very long base. Very long. That base is that's a head and shoulders failure, number one. So that's going to take the head. That's a $37.15 stock. And that's a base that on this side has been going for a year and a few months. And the total of this pattern that we're talking about here is from 2013. So yeah, huge pattern, huge. So yes, I would notice if I had been looking at a stock like Weyerhaeuser, I would have seen it. I often skip a lot because they're too slow, my excuses, but options on that would have been fine. And last but not least, strong trending pullback layers, meaning you get that stock where Dan and everybody has to have it, you wait, get a small pullback, you find something, a fib, a trend line, a bottom of a channel, a BSL, a prior topping resistance line, TRL. You find a couple of layers in there, 3, 4 things, go long because the trend is strong, and there's usually a persistent follow through of that trend. But I'd like to have the market also in alignment, not sitting right at resistance so that it fails. I hope I didn't go too fast. We record this. I stayed at less than 2 hours. We did this in over an hour and a half. But list any instant questions I can kind of roll together, and we'll get you out of here, and we'll get a recording together. Anybody have a question? Thanks. I appreciate that. Anybody else with a question real quick? Anyone? Bueller? Hello? Okay, so everybody's good. I don't see anybody. Wait, support has been working. Support and resistance, that's what I've been working on for 3 years. You can't spend enough time on it, on support and resistance, because you don't realize the value. That one tool alone can tell you trend. It can tell you the flipping of a trend or changing of a trend. It can tell you where to buy. It can tell you where to sell. It can provide enormous R. Support and resistance is like, like I said, if you took away every tool, I could live on support and resistance alone. And I would bitch and moan, but I have to tell you, I could still make money with it. Because the R formula mixed with support and resistance is all that's really needed. Let's see, give me examples of channel breakouts. A channel breakout would be above the channel. So that was the example I just showed you in BABA. That is a channel breakout above it, and it TRL'd the top edge. It flipped it. Blown away is what I need for, okay, thank you. I appreciate that. I'm glad you're blown away. I focused on just a few stocks. Fantastic, Patrick. Again, I have to remind myself that's all it takes. The psychology is I want my hand in everything. I want to be a superstar. But the truth is this game is a lot easier if you just do a couple of great things. Thank you. Okay, no problem. Can I look at LABU and see if we have an M bottom? Let's see. LABU. You have the beginning of a very small potential early on. This is not an M bottom. This is let me go to a real chart that I actually used. That was, okay. You have 2 peaks on a massive trough that has been basing flat. I would have rather it been a little bit cleaner here. This could be, if this side goes all the way down here and then takes out this high, I could see it, but it's not gorgeous. And it needs a lot of time for it to have developed. If it just goes through those 2 peaks, that's a breakout above $55.70. Let's see. and made a few stock fans recommendations. Okay, yeah, great. Thank you. Can we review the UPS as well? UPS. So UPS, if you're asking me if this has any M bottom, let me see, April through July. I can pull over my weekly and I can already tell you, or I can just switch it here. And the answer is not a chance that anything here is an M bottom. The M bottom would be in the trough. You have to go back to the trough. It's down in this bottom. If these were two gorgeous peaks right at the same level approximately, pulled back nicely, this would be the M bottom going long up here. I mean, on this way up. The M bottom could not be started before with an uptrend coming into it. And it doesn't matter if it's a shorter time frame because you're ruining the idea of what it means. Remember, even though you may use an M bottom on a shorter time frame to call it, it's really just a double top failure. And those work. Don't get me wrong. Double top failures and double bottom failures, they work. They totally work. But if you're asking me the difference of an M bottom is a ton of players, daily players, weekly players, all getting positioned with their stops above one area and all being shaken out on that second pullback. So when you go above that area, it's that order flow disaster, the cascade of orders that all just keep coming and refreshing because the stops, they don't care about the first 50 cents over the edge because they're pros. But once they see it coming at them and it's not stopping, they start going, maybe we have to rethink the idea. So the stops just keep coming and the sales just keep coming. And it's that order flow cascade that creates those massive M bottoms. Does a double top failure work? Yes. And guess what? They work. Here was one on Facebook that was a trade. Where was it? Darn it. That's weekly. That's why I can't find it. Right here. There was like a double top area in here where I don't remember. I was looking at a 60-minute chart and I didn't pay attention. This was a double top failure and the stock just ripped from it. So yes, it's not an M bottom, but it's a double top. A double top can fail and create a buying frenzy, but it's not the same as an M bottom. Is short term. Okay, yeah. You predominantly use daily, 30-minute, not the daily plus 60. Oh no, I use on my charts, depending on the system I'm in and the rest. And you don't always see all my charts because I have multiple computers as a backup. But I won't put everything on one system because if it goes down, I don't have everything. But if I'm looking, I will look at daily, and this will change to be all throughout the day. I will be switching this to 4-hour, and I will be switching this to hourly. And so I will just keep going back and forth and looking at daily. Now, to my left, I showed you my weekly. I also have other charts that are above me. I also have, remember, I have 7 screens. So in essence, you're only seeing one view of what I look at. I'll also switch to an individual one time frame chart and just look at that to get an idea of what's going on stock. Because I don't want all that noise. I want to get away and try to start to get a picture without all the noise of where price may be going to here. So if I'm using charts, which means that's 99.99% of the time, not my watch list, I use charts more than anything, then it will be weekly, daily, 240, 60, 30. That's where I spend all my time on those. The most important is probably the weekly, daily, and the hourly for me. Those are probably the most important. Okay, guys, it's 6:05. We saved you 10 minutes off 2 hours. I'll work on getting this out in the next 48 hours, and I will send you a link out for signing up for the private feed for those who want to, and have yourself a great night.